Hello and welcome. I'm Craig Harrington, and today's topic is the sinking dollar. On March 19th, the Federal Reserve agreed to purchase $750 billion worth of mortgage-backed securities, which are now backed by the U.S. government. This is on top of the $500 billion that it is already in the process of purchasing from the Treasury, and the $300 billion in long-term Treasury securities that it intends to buy over the next few months. The Fed says that this spending spree, this $1 trillion program, is part of its plan to revive the economy. But the very act of buying all these bonds and securities could undermine the economy that it's trying to protect. According to Paul Craig Roberts, a former Treasury Secretary during the Reagan administration, the Federal Reserve may be buying up these assets in preparation for failure. They know, just as we all do, that printing money leads to inflation, and printing trillions of dollars could lead to rampant and unchecked inflation. They may be buying these assets preemptively, preparing for the destruction of the dollar due to its own inflation. According to Roberts, the answer to this question probably lies in how the unprecedented sizes of the budget deficits in fiscal years 2009 and 2010 will be financed. The United States cannot finance the budgets, and even our astronomical foreign lending may not be enough to cover all of these expenses. As investors flee private markets, they may turn their investments over to the perceived safety of the Treasury. This would crush the markets, but it would, in some way, finance the government. With the markets seeming to self-destruct anyway, this is a frightening possibility. John Williams of ShadowStats.com thinks that the budget deficits will be financed by monetizing debt. The Federal Reserve will buy most of the new bonds and create demand deposits for the Treasury. In effect, the money supply will grow by the amount that the Fed purchases in new Treasury debt. It will, in essence, print brand new money. Printing money to finance the government's budget normally leads to high inflation and high interest rates. Right now, inflation is relatively low and interest rates are at all-time lows. We could see these reversed quickly in the future. The Fed's initial plan, when it announced that it was going to buy $1 trillion worth of Treasury securities, was to drive up bond prices. It announced that it would continue purchasing vast amounts of Treasury securities to stabilize the market. However, this could result in a rapid growth of the money supply here in the United States, which would hurt bonds in the long term and push the dollar even further down. According to the New York Times, the dollar fell about 3% against other major currencies following the Fed's announcement. It is clear that international currency holders are aware of the risk involved with this Fed's plan. Right now, the best options being proposed by our financial and monetary leaders are effectively hurting our own currency and economy. If the currency exchange rate for the dollar continues to falter, our financial situation becomes even more cloudy. Our addiction to foreign goods will become increasingly costly as our money becomes less and less valuable to our foreign suppliers. And our repayment of foreign loans will become more expensive as more dollars are necessary to just break even. In order to deal with this, the government would have to mint more money, increasing the money supply in reaction to the rest of the world. At some point, printing money is no longer a viable option because all it does is debase the domestic currency. And that is precisely the situation we face in the United States today. Our currency has become nearly irrevocably fragile. The Chinese have even begun to publicly question the stability and validity of the dollar as an international currency. If the inflationary process gets out of hand, the United States could find itself in an even worse position than it could have ever imagined. Financing wars and bailouts is incredibly expensive. Other countries have been able to finance their own bailouts because their governments actually have money, and they actually have assets to back their spending. The United States has virtually nothing. We live on foreign loans and borrowed time, and time may be running out. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other related topics, please log on to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!
Produced by economyincrisis.org.